Good afternoon, everyone. It's great to have you here. I'm thrilled to be joined by Geeta Gopinath, who will be joining us today in this joint event of the IMF and the Department of Economics at Universidad de los Andes in Bogotá to talk about the outlook for the upcoming months and the projections for economic activity in the coming months. Geeta, it's great to have you here. It's a great honor to be joined by you today. The event will have the following structure. We'll have a 20-minute presentation by Geeta. Then we will be interacting with some questions that we have prepared for her. And then we will be taking questions and comments from the audience with the expectation of the event taking for about an hour. So Geeta, great to have you here again. Welcome, and the floor is yours.
Thanks, Marcela. It's a real pleasure to be here. If not in person, but at least virtually to somehow connect with Bogota. So I'm very, very pleased. So let me jump into my presentation. For that, I'm going to share my screen. Okay, so I assume you can see my screen, and I'm going to put it in presentation mode. Okay, so as Marcela said, I am going to give you a very quick tour of the World Economic Outlook that we put out a couple of weeks ago. Actually, now almost a month ago. But what we saw in terms of where the world economy was headed, what the risks were, and what were the policies that would be needed. So I have about 20 minutes. I'm not going to be able to go into great detail, but I look forward to engaging with you also through Q&A. So we've called this crisis the Great Lockdown because it is featured by almost all countries going into different levels of lockdown. Now, what we've seen recently, of course, is in the last many weeks, we have seen countries reopening and restarting their economies. But if we were to think of what the recovery would look like, there are two characteristics. One, of course, that it's highly uncertain, because in the absence of a medical solution, the crisis hasn't gone away, and you could have further lockdowns. And secondly, a highly uneven, because there are some sectors like tourism, restaurants, hotels, that will continue to be negatively impacted for a long time, while you see other sectors, digital sectors, medical, all of those seem doing well, and some other sectors are also recovering. Certain kinds of retail sectors are recovering quickly. So if you look at this graph here on the left, this is our projection for the path of world GDP. The blue line is what we had projected the world would look like in January of 2020 into 2020 and 2021. The green line is what we projected it would be in April, at which time we had said that this was going to be the worst crisis since the Great Depression, with the global economy expected to shrink by 3% globally, and then have a partial recovery. And in June was the red line, which is you have an even sharper contraction for 2020 of minus 4.9%, and an even more subdued recovery into 2021. So if you look at the gap between the blue line and the red line, that's a loss of over $12 trillion to the global economy coming from this crisis. Now, that said, the crisis is not over. There is still tremendous uncertainty on the current recoveries that we're seeing in many countries. There's uncertainty about the pandemic and how it will evolve. Financial conditions are relatively more sanguine than the real economy is, and his debt is at historically high levels. So there is a possibility of financial disruptions. And geopolitical tensions can escalate, as we are seeing recently. So the policies at this stage is one where governments basically have to adapt as the situation evolves because it's so fast changing. Since there's still a health crisis, you need to support health systems. You'll have to shield affected people and households and help firms who would otherwise be viable in the absence of this crisis. But as this crisis goes on, some sectors will shrink on a more permanent basis. And you would have to then have policies that enable reallocation of resources away from these sectors to sectors that are growing. There's also an opportunity coming out of this crisis to have a much more inclusive and green recovery for the global economy. Now, there are many demands on fiscal resources, but not all countries have the fiscal space to do it. And international support will be crucial for vulnerable economies, and also to ensure that there is no, that the world doesn't see a big rise in protectionism. So these are the three phases of the Great Lockdown. The first phase is when countries were entering the lockdown. That's my first row. The second is where we are right now, which over 75% of countries exiting. But it is tentative because, as we know, cases are going up and returning in many parts of the world, and you're seeing lockdowns being reimposed. The last phase is when you truly escape the Great Lockdown, and that's going to happen when there is a treatment that works well or a vaccine. And neither of those exist at this point, but certainly there is optimism that that will come around maybe in 2021. So what this graph shows you is that the pandemic is everywhere. There is, there is no part of the world that has not been spared. Look at advanced economies, number of confirmed cases. If you look at emerging markets, the pandemic, which originally started in China, moved to Europe, then moved to the US, and then the epicenter moved to Latin America. And then you have low-income countries where the cases are growing, but still it is relatively subdued relative to other parts of the world. But the point is that this health crisis knows no borders, and everybody is being affected by it. So in my next few slides, I want to kind of give you a glimpse of what are some of the interesting features of this crisis, especially as compared to previous crises. So let's look at what's happening. So one is, for instance, the services sector. So if you look at a typical crisis in the past, the global financial crisis or debt crisis, other kinds of crises, the sector that gets hit very hard is manufacturing. Why? Because investment falls and manufacturing gets affected by that. And then you do see some negative effect on services, but it's not that large because consumption tends to hold up. But because this crisis is basically asked people to stay home and for all kinds of economic activity to shut down, what you see, and you can see this in the red bars, that the contraction in services was much bigger than in manufacturing. Now, the orange bars tell you that things are improving and they're recovering. And you see the orange bars or the yellow bars in June are showing that things are better than in April. However, at the same time, it's not as if we're seeing very large amounts of expansion. Another unique feature of this crisis is the speed with which everything has happened and the scale with which it has happened, which is you've seen employment fall precipitously. And in some countries where there is, people have moved into unemployment insurance, you see this big drop in employment, and you're seeing some recovery now. But this is going to be a challenge coming out of this crisis with a very large number of jobs lost and a large number of people who find themselves without productive work. The recovery that we have seen is also uneven. So if you look at China, which is one of the first countries to come out of to reopen, you can see that industrial production has recovered quite strongly, but on the other hand, a sector like catering services is still in contractionary territory. Similarly, in the middle figure, you see that for the US, you're seeing recoveries in retail, but restaurant bookings remain depressed. And trade has also been hit severely. I mean, goods trade has been hit just as you had supply disruptions. But then also you've had services, big hit to services trade through big contraction in tourism. A question that always came up at the beginning was that because this is a crisis with major supply shocks, that would we see a burst of inflation? But this has also been a crisis with big demand shocks, because while on one hand you've told factories to shut down, you have also told people to stay home. And so the question is, what would that net effect be on inflation? What you see on the left graph is that food price inflation went up as demand stayed high and you had some disruptions. But in the middle graph, you see consumer price inflation pretty much across the board. This is low-income countries, advanced economies, emerging markets, has come down. Now, one factor was commodity prices that fell sharply, but also more generally, some depressed demand in other sectors. Now, question is, what will this look like when we come out of this crisis? Is it going to be that there's so much pent-up demand that inflation will come back up? Or is there going to be, because of the uncertainty, there's still a lot of precautionary savings? And I think the sense is that inflation will remain subdued for a while. Now, commodity prices, which plummeted, have improved recently relative to their low point, but still, we are well below pre-crisis levels. Now, this time around, unlike in some of the previous crises, the support in terms of monetary and fiscal support has been really swift and out of a very large scale. Now, there is heterogeneity. So if you look at advanced economies, so this is my left graph on announced fiscal measures. The red bars are, for instance, additional spending and foregone revenue, which directly affect the fiscal deficit. What you see is advanced economies doing substantial, like over almost 9% of GDP in terms of direct effect on the fiscal deficit. If you look at emerging markets, what you see is about a third less. So they're about a third of what the AEs did, and low-income countries are about a third of what EMs did. And you can see there I've marked Colombia, which is on the upper end of what emerging markets have done. There's been a lot of support. Countries have tried to replace lost income, and in many parts of the world that has been quite successful. It's a bigger challenge when you have a large informal sector, and monetary policy support has been very large. Now, because of all of this support, there's been one positive surprise that came out relative to April, which is that financial conditions have turned out to be easier than one would have forecast. So EM portfolio flows that fell dramatically in March, and you see that in mid-February and around March time, you see a big drop in the red line. And I have the dotted lines, which are for Colombia, for Latin America. And you can see that there was a bigger drop this time around as compared to the global financial crisis, but it's stabilized. And in some places, you're actually seeing a recovery. And the right-hand side graph shows you that there are countries that had big depreciations of their exchange rates that have now seen appreciations. And you can see Colombia in there, which had a big depreciation initially, but now has had some improvement in the value of its exchange rate. So a question that's going to be asked is what is the relationship between economic losses and the severity of a pandemic in a country? The left figure does that. This is still preliminary work. It's looking at the first quarter of GDP forecast errors, which again still is, many countries were still not as badly affected. You do have a negative relation, which is countries that had a higher level of debt per capita had a somewhat bigger negative impact on their GDP, but it's still a weak relationship. What you do see more strongly is the negative relationship between mobility and the big hit to GDP, which is the countries where mobility fell the most were the ones that had GDP fall almost as you would expect. So in making the projections, we have to make some assumptions. This slide has the assumptions that we put out. I'm just going to tell you one of the important assumptions is that in the second half of this year, while we do expect that there will be, some reimposition of lockdowns, we are assuming that there will not be the kind of very stringent nationwide lockdowns that were put in place in the first half of this year and for at least as long. Now, if that were to change, of course, the forecast would change. So here are your projections. as you can see, this is the world as a whole is minus 4.9%, and a recovery to 5.4%, which is a partial recovery. Almost across the board, if you look at all advanced economies, you're seeing very large negative growth rates. So this is a big hit to all of these economies. It's a crisis like no other for them. The next graph is for emerging markets. And you can see there that for emerging market and developing economies also, for the first time, they are also in a recession along with advanced economies. Usually it's one or the other, but this time around it's both. And you have some recovery in the second half. If you remove China, the effects are even larger. And you can see the difference between commodity exporters and where the effect is even more severe. My next graph has our projections for Latin America. So as you can see, for emerging and developing economies as a whole, we have negative 3%. For emerging developing Asia, it's minus 0.8%, but for Latin America and the Caribbean, it's minus 9.4%. So it's a very large hit to this region as compared to some other regions that you have. Well, everybody's being hit very large, but among emerging markets, like emerging and developing Asia does a little better, and that's because, to a great extent, because of China. And we have the specific numbers in there too for the other countries. So this is the number for Colombia. We have a projection of minus 7.8% in 2020, and then a rebound to 4%, but that's a partial recovery. So if you look at the path of GDP that's being forecasted, what we have is a deep downturn. And then for most countries, we don't have them returning to pre-COVID levels, even by the end of 2021. So this is a pretty persistent shock, which you do see a recovery, but the recovery is quite partial. We've also looked at alternative scenarios. Now, you could have an upside scenario, which is that we could have even better news on treatments and vaccines that could bring about more confidence. People would engage more in activity. And then you can see the green line, which is you can see a recovery happening much faster. But the red dashed line is what happens if you have a second outbreak and that's severe and calls for the kinds of curtailment of activity that was done in the first half of this year. In that case, we are looking at basically no recovery, which is you get a big drop and then a flat line. So literally an L-shaped recovery, as it's called. Now, among the risks, the first on the left-hand side is the risks from rising infections that can happen. And this is a concern that's a reality at this point in some countries. The equity market indexes, which reflects the fact that financial conditions have improved quite a bit, could reverse itself. Easy financial conditions could go bad if there is worse news on the pandemic. And the geopolitical risk index is also going up. Also, we should flag that because of the big contraction in economic activity and the fiscal support that's being put in place, we now have public debt globally to be at the highest level in recorded history. So this is even higher than the post-World War II peak. And you can see that for advanced economies and for emerging market economies. This is now making it, this is a risk, especially for many emerging markets and low-income countries, as they have debt buildup. And this is risk both, the fiscal risk, but also the external risk that they face in terms of external financing needs. And so you can see there the number of, the fraction of countries that have high and medium risk of distress. Another concern with this crisis is the scarring that's come about from it, and it depends on what sectors you have in your economy. So for instance, the left graph, you see tourism, a country that's heavily dependent on tourism. You've seen a collapse in activity and really no recovery, while you've seen recovery in other sectors. So this becomes a major growth challenge for some countries that rely exclusively on tourism. The middle graph shows you that in the absence of policy support, SME bankruptcy rates could be very high, and especially in certain sectors that rely more on in-person contact. And so this is bankruptcy is a big risk. And a third major issue is that, unfortunately, this is a crisis that is projected to raise poverty rates around the world. It's going to, according to the World Bank, it's going to add about 70 million people into extreme poverty. And this is something that will have to be dealt with. I'm going to mention some positives, which is that there are, of course, opportunities that a crisis presents itself with, which is as countries are planning for recoveries and how to stimulate activity, a green recovery, of course, would be beneficial for countries and for the planet. And the right-hand side graph tells you that this is going to be a time of digital transformation around the world. You've seen this during the crisis, but this is going to be a sector that will require investment going forward, because there are still large gaps across countries in how well developed their digital infrastructure is. There's almost half of the world that still does not have access to the internet. And so these disparities will have to be reduced. On my next slides are the policy recommendations that we make. These depend upon whether you're a country where cases are rising and you're still in lockdown, or phase 2, when you're a country that's reopening, the cases are under control, and what kinds of measures should be taken. I'm not going to read through each one of them, but the basic idea is that in the first phase, when countries were in lockdown, it was important, of course, immediately to support people and firms to ensure that job matches were preserved. That is, that firms and workers stayed connected. To make sure there was enough liquidity in the system. Now, as the crisis elongates, and you have now the second phase where you're reopening, now there are going to be sectors that no longer are going to be viable because there's going to be much more persistent effect on them. Travel, for example, is one such sector. In that case, the support has to move away from kind of keeping workers attached to the travel sector, but actually supporting their reallocation away. You still would have to rely on making sure that there's income support for the vulnerable population through unemployment insurance. You're going to have to encourage hiring through hiring subsidies, especially targeted at young people and older workers who tend otherwise to be, stay out of the workforce for a very long time in a crisis. And so those measures will be needed. And then there will be some sectors that will have to go through bankruptcy. To improving your institutional framework to deal with this is going to be very important. And of course, it's important to seize opportunities for a green, more equal and digital friendly recovery. Now, to accomplish all of this, international coordination and support will be essential. It's essential on the health front, ensuring health supplies, health capacity in different countries. And also when there is a vaccine, that there's enough production and distribution of that, including for other kinds of medical treatments. It's important for the international community to help developing economies finance critical spending, including health. And in this case, this means that in some countries, this would be providing debt relief for countries. These are some of the instruments that we're using at the IMF. We've given emergency financing to over 70 countries. We have debt relief that's being provided to over 25 economies, I believe 28. And international liquidity needs are also very important that the international community makes sure that there is sufficient international liquidity in the system so that emerging markets can have access to financing at reasonable rates. And of course, it's important to make sure that that there is cooperation on the trade and technology front, and that disagreements can be resolved through a multilateral rules-based trading system, which also requires work. I mean, you have to also improve how that system works. And the IMF is actively supporting member countries on all of these fronts. So with that, let me stop and hand it back to you, Marcela.
Thank you, Gita. Great. Thank you very much for that presentation. Very comprehensive and extremely worrisome presentation. Let me try to focus this a bit more specifically on the particularities of the kinds of countries that are of most concern to us. that is to say the region, Latin America, and the peculiarities that Latin American countries share with other emerging economies. One, I know if you could share the slides, that'd be great. I don't see them yet. One issue that I wanted to raise is that of the composition of employment and in general activity, and peculiarities that we have. If you can move now one slide up, please. That the region and Colombia in particular has compared to advanced economies. One issue that's very salient is the presence of informality, self-employment, small business prevalence, and the characteristics that are attached to that. And here are some numbers that we have produced here at the department. This is from a joint work with Laura Alfaro and Oscar Becerra. And it's just an example based on the data for Colombia of what these characteristics are. So informality is extremely high. Of course, it depends on how you measure it. The magnitude of it depends on how you measure it, but numbers vary between something close to 50% and a bit over 60%. And I don't have a number there for comparison, basically, because in many advanced economies, this is not even measured. Self-employment is more than 40%, almost 50% in Colombia compared to less than 15% in the US. Employment at firms with less than 10 employees, including that self-employment category, is well over 70% compared to, again, something closer to 15% in the US. And if comparisons were made with, say, Western European countries, things would be similar. At the same time, the labor force itself and the occupations in which people are also in a worse position to face the crisis. For instance, there is less ability to work from home, even though more people had businesses at home before the crisis. More people are in jobs that require a high extent of physical contact with others. In all of these dimensions, phases with more stringent effects. Informality, firms in small firms are all in the area where it's more difficult to navigate the crisis. You have less access to financial help, to loans. You are also less able to rely on social security assistance. So all of those are signs that are worrisome to these countries. Can we go to the next slide, please? At the same time, however, that some of those features also may suggest that the recovery may be easier and more phased or more focused on the informal sector. Jobs that are formal are harder to restart. Firms that are formal have a harder time coming back to life because they have to face the costs associated with regulations that are not there for informal firms and jobs. And so because of those reasons, of the set of all those reasons that I have mentioned, you would expect much harder effects on employment in particular than in developed countries. And here is a simulation of what could be expected based on the risks that I mentioned at the beginning, varying the structure of the economy from the Colombia to the US structure. And what we call here the early crisis is the stage at which small firms and informal jobs will be hit. And if you start with the basis in Colombia of 22 jobs, this implies that more than 50%, well above 50% of jobs are at risk. But then if you go to a recovery phase, and all of those informal could come back to life easily or more easily than firms and jobs that are formal, you would see that the recovery is faster. So I guess that dichotomy I wanted to just lay out and ask, in your view, what is the advisable balance between the protection of informal workers that are so hard hit at the beginning of the crisis in the absence of the social security networks that workers in other countries and formal workers have, versus balancing that with formal firms and jobs that are scarce and therefore probably not so important in magnitude as compared to those in developed economies, but precisely because of that reason are so important to protect.
Yes, no, the distinction you made between formal workers and informal workers is a very important one. And in fact, another unique feature of this crisis is that unlike previous ones, when you had a recession in countries, what typically happened was that workers would go from formal sector into the informal sector. The informal sector was like a shock absorber. But in this time around, because of lockdowns, we don't really have the informal sector being a shock absorber. Instead, it's also being hit as badly as the formal sector has been hit. And so the question is, what does policy do? The first thing, of course, policy has to make sure that people's livelihoods are maintained. And especially given how large the informal sector is, as you mentioned, I showed on your slides, if you're going to help people, you absolutely have to help the informal sector. And this is being done in many ways through cash transfers. And if you do that, especially through digital payment platforms, you make it much more unconditional. I mean, that's the support that you need. Now, the question is whether in this recovery, we would actually see informal jobs come back as quickly. Concern is that because in many countries, the informal jobs are precisely in the sectors that are being hit by the lockdowns and are being hit by people deciding not to engage in those activities. So like restaurants and tourism and things like that. The fact that you could get a quick recovery is not assured even in the informal sector. The second thing is that when you look at the formal sector, of course, is where most of the, if you look at productive activity in terms of the relative productivity of the formal sector relative to the informal sector, it's in the formal sector that you have much more productivity growth than in the informal sector. So from a medium to long-term perspective, you absolutely do not want that sector to shrink. If anything, you want that section to grow. And I've seen that with, for instance, I know that Colombia is doing many reforms in that direction. So again, in terms of how should policy be tailored, I would say policy right now has to make sure that people have their basic livelihoods met, and that would be essential. Then there is the question of how do you support firms? And in the initial phases, of course, it was very important to keep firms alive so that once the recovery starts, that they can go back to full activity. But as the crisis goes on, you're going to have firms that were viable become unviable and become insolvent. And that's when you're going to have to be able to encourage movement of workers away from some sectors that are shrinking, like say travel, to sectors that are growing, for instance, in the digital space. Now, that's not going to be an easy transition. You're going to have to be able to provide maybe hiring subsidies. You're going to have to provide reskilling and retooling, but that reallocation will be necessary.
Thank you, Gita. Let me take you now to the fiscal front a little bit. We've seen in the numbers that you've presented important fiscal packages that governments have undertaken around the world. But we've also seen that those packages have been more timid in emerging economies and developing economies, and in particular in Latin America. In many cases, that is explained by less fiscal space. But it is also the case that what fiscal space is a bit of a cloudy definition. That is to say, countries may choose to expand their fiscal packages and at least try to find the funding for those more expanded packages. one concern that I think is important is the fact that fiscal health is not only being hit by these increased spending related to the crisis, but also, and very importantly, by the reduction in tax collections in some of our countries, pushed partly because of the falling commodity prices, but also very importantly tied to the same economic contraction that is implying the less ability to collect taxes. So I'm wondering about the balance between these two things. Do you think that greater stimulus packages are advisable for emerging countries that seem to have lower space, but given this understanding that easing the impact on incomes, which could be the objective of these more generous packages, and subsequently increasing thus the ability to generate tax collections, may be a better bet than just abiding by what seem to be the current fiscal constraints?
Yeah, no, it's great. That's a great question. This crisis has called for large amounts of intervention. There's no doubt about it. This is not a crisis the country has brought upon themselves, but it's an exogenous shock and they have to respond to it. So fiscal policy is absolutely essential. Now, of course, that begs the question of how do you actually finance all of that? And so you made some very good points. The first point is that if you didn't provide sufficient support to your people, then you actually can end up with worse economic activity, worse economic outcomes, and that's going to affect the amount of tax revenue you collect. And so you could actually end up in a worse situation fiscally by spending by lesser amounts. So that, of course, is one point. But there is a real distinction between being an emerging market and being an advanced economy. Emerging markets are certainly much more constrained in how much of debt that they can run up. So this is the trade-off, right? On one hand, you're doing the fiscal spending to stimulate growth. And if you're an advanced economy major reserve currency issuer, then you can do that while keeping your borrowing rates extremely low. And so that can help you with your debt sustainability. But for many emerging markets, as they build up debt, you might be able to get growth rate up, but you also have this risk of interest rates going up, and especially going up very suddenly when you have a change in financial market sentiment. So there is an optimal point. There is only, you can't rely entirely on the policy delivering growth channel because you have to worry about what can happen when you have changes in market sentiment or real concerns about that sustainability, and that can trigger big movements in interest rates. I think the expectation is that interest rates will stay low for a long time for many countries, but it's not guaranteed. And right now, financial market conditions are relatively speaking, calmer, but that can change very rapidly too, which is why, the right policy mix is to do fiscal stimulus now, but at the same time communicate, commitment to medium-term fiscal consolidation. Because when you do that, you also assure markets about the path going forward, and that helps you keep rates low.
Thanks very much, Geeta. Let's now move to one of the things that you mentioned at the end of your presentation, and that is the concern about poverty and inequality. The projections of my colleagues, Andres Alvarez and Oscar Becerra here at the university, talk about a very worrisome potential 20-year walking back in terms of the gains that we've made in the fight against poverty. And other projections that are less strong, but still very worrisome, talk about a lower bound of 10 years rather than 20. So any of those are extremely concerning in a country that had taken pride in making lots of advances in the fight against poverty. Here are some numbers from that work, which basically talk about an increase in inequality that's very important about brought about by the increase in poverty. Anna, if you could move to the previous slide for a second. And a very impressive shift in the income distribution. So the question is, given that poverty will undoubtedly rise as a consequence of the crisis, and given the fact that though this is worrisome, obviously around the globe, it is much more worrisome about for countries where poverty and inequality in particular are so prevalent as they are in the countries in Latin America, and for those that had been making progress in the 20,000s in the fight against poverty. What is your view on how should policies in these countries, what would be the optimal policy mix, and how would that mix vary compared to advanced economies? Not only to mitigate the impact on the vulnerable, that's not only to make sure that people can go by during the crisis, but also to try to reduce to a minimum the permanent income that this will have on the permanent effect that it will have on incomes, and therefore in poverty in a more structural way.
This is a major concern. It's true. Like, Colombia is an example. It's been successful over the last decade in bringing poverty rates down. But the projections for most countries in the world is for poverty rates to go up, and to go up significantly. Now, this is again by income levels, right? Now, like you said, it's very important for governments to make sure that the vulnerable people who've lost incomes, lost jobs, that they receive government support to make sure that they can maintain their livelihoods. So lost income should not translate into lost, kind of basically lose complete consumption, your consumption ability. And that's essential. Now, going forward, one has to ensure that this recovery is a job-rich recovery, because there are a lot of these people who've lost jobs. And the question is, how do you make that happen? There is one kind of spending, government spending, that tends to be job-rich, and that's, for instance, public infrastructure spending. And investment of that kind historically has created jobs and helped bring people back out of poverty. A second important policy action will be to make sure that low-income people, low-skilled people get retrained so that they can work in sectors where there is actual demand, as opposed to sectors that are shrinking. So, and lastly, and this is again something that even Colombia has done, which is one of the main reasons it's been able to bring it down, is that to continue to give very strong support in terms of healthcare, in terms of education, in terms of children, poor children. I mean, these are measures that will have to be continued. I think a lesson that will come out of this crisis is that countries will need much more stronger social safety nets, and that they will have to work hard and make structural changes to bring down inequality and to continue the fight against poverty.
Okay, so we're getting extremely interesting questions on the different chats, and so I want to make sure that we get to those. But I don't want to turn to that before making sure to ask you to cover one of the areas where you, of course, have most knowledge, even coming into your job, and of course, a great responsibility right now, which is that of global trade and global interactions. Globalization in general had been under discussion before this crisis, but it has been put against the fence given recent developments in the last months. Global chains have been disrupted, and in many countries we hear calls to protect the national industry, and that sort of there is the temptation to try to close countries even more to try to make sure that the internal demand is focused on the internal production. And so I wanted to hear about a little bit about your views on where is globalization headed and where it should be headed, and how countries should be thinking about it right now before turning to the questions from the audience.
Yep. The risks to globalization are severe. I mean, I'm not going to lie. It was the dissatisfaction with globalization, the push towards protectionism came about even before this crisis hit. And this crisis will certainly aggravate that. The important thing to keep in mind is that for a country, and especially if you're a country that relies on international trade and international finance, there are large benefits that you get from it. Another way of saying it is that if you're going to decide to put controls on what you import, you can expect retaliation from other parts of the world, which means that you're going to potentially gain by moving some of your demand home, but you're going to lose demand in the rest of the world. And that's what happens when everybody moves towards much more protectionist measures. Secondly, we know that most trade these days, most exporters are also importers. And so when you are producing a good, you use inputs not just from your own country, but from the rest of the world, and then you export that to the rest of the world. So if you're going to force firms to use only domestic inputs, there's many studies that have shown that there are important productivity losses from that. So that's another thing that has to be kept in mind. Third, if you're going to shut down trade, you're obviously going to shut down financing too, international financing. And that means you're going to have to rely more heavily on your domestic savings, and that puts pressure in terms of borrowing costs. So these considerations have to be kept in mind. I think it's absolutely important to fix the problems with globalization. It's not been a win-win for everybody. There were domestic policies that had to be put in place that were not put in place, because of which people have suffered. Those have to be rectified. The global community has come up with a much more improved multilateral trading system. There are some sectors where there is still much more progress that has to be made. For instance, services trade, there was discussions for a long time about improving or relaxing conditions there, but that hasn't come about. So there's much more to be done on that front. But it's important, again, for countries to keep in mind that when you go inward and everybody goes inward, then you're losing a very large market that's out there too. And you're losing access to very productive inputs that are essential for your own production.
Fantastic. So let me now turn to some of the questions from the audience, and I'll just read this one. It says, this spring, the U.S. Congress provided $2.4 trillion in relief, and the Federal Reserve provided yet more. That is close to 25% of gross domestic product, one of the largest spending efforts in the world. Other countries are also with serious public spending efforts. What effect will this huge public spending and debt have long term? And so I have to say, debt is in upper cases.
This is certainly a time where, if you can put in the right amount of targeted support, then that is beneficial for your recovery, and you can have a stronger recovery going forward. So in this case, in the case of the US example that you mentioned, is indeed one of those where all of the support measure we know has helped households. So you can see that in terms of income replaced for people who've lost jobs. And you see that in terms of, as you have reopening, as you see spending behavior, you can tell that people were not badly hit in terms of lost income. And that is important. And similarly, keeping firms viable so that they can return to activity is also very important. Now, in the case of the US, of course, the prediction would be for them to be able to continue to borrow at very low interest rates going forward. And so, overall, the debt trajectory, keeping interest rates low with growth coming back up, that helps improve the debt dynamics going forward. And so, this is an example where it will take a long time for those debt levels to come down. And again, even in the case of the US, it's important to have a medium-term plan for how to bring down those debt levels. But at this moment, it makes sense to provide substantial support.
there is a set of questions related to the other one. So let me summarize them by asking about particular measures that have been put in place to ensure that these weak economies, the resilience of these weak economies. So people, different persons are asking for a little bit of more of texture in terms of what these packages have implied.
Yeah, so the packages have, I mean, all of them have had a kind of a common theme, which is to protect livelihoods of people who've lost jobs and to initially to kind of blanket protect firms and especially small and medium enterprises. Now, how you've done it depends on what the country is. So for instance, in the US, they've relied heavily on unemployment insurance. They introduced something called a payment protection program, which also encourages firms to keep workers. While if you look at, for instance, the case of Germany and Japan, they've always had this short-term work program that, again, you know, where firms reduce the number of hours worked of each worker, and then the government subsidizes the wages. And so, you know, you get the full income, but for lesser work. And that way you can keep workers and firms matched. Now, in many emerging markets and low-income countries where you don't have formal employment, but it's informal employment, that doesn't really work. I mean, unemployment insurance is not something that many of these countries have, or short-term work programs. In this case, it's been more the form of direct cash transfers. And that's true both to workers and also to self-employed people. And countries that have had digital payment systems have been able to do that much more quickly. Because, you know, in this crisis, you want to be able to get money into hands of people without having to contact them physically. And also by making it much more unconditional, so kind of expanding the scope of who gets it. In terms of firm support, there's been a lot of support which is in the form of liquidity support, which is to help firms, you know, get financing at cheaper rates and able to continue to you know, pay some of their bills. But there's also some which is taken the form of grants. So support which basically helps the firm keep workers. And if you do that, then effectively what we're giving you is a grant. I think going forward, you know, policies that are more in the form of loan support or debt or kind of that add to the debt of a firm are going to be harder because many of these firms are going to have, they're going to be in a situation where they have very high levels of debt overhang. And so, you know, an approach which is kind of more equity-like, which is where the government gets the upside, but it's not like debt, which you have to pay on a particular day, regardless of how your state of or the state of the economy. Those ones would work better. So these are different kinds of measures that have been done.
Okay, so there's also a set of questions about the peculiarities of Latin America in general, but also about the peculiarities of Latin America in the current weeks. One specific question that I think summarizes many others is, we have been seeing that cases of COVID are rising in Latin America, and in some countries rising very rapidly. Colombia seems to be right now in the middle of the upward sloping part of the curve. And at the same time, we're seeing unemployment rise very sharply as well in the region. So the question is a little bit about how to keep the balance between those two ends right now, given that, as you have pointed and many have pointed, lockdowns are one factor, one very important factor between the economic impact, but then at the same time, we have this huge increase in cases and contagion.
Yes, I think this is a dilemma that is facing many countries. And if you look at, you know, how to deal with, I think in the first half of this year, the strategy was to have kind of very broad-based lockdowns, kind of untargeted lockdowns. This time around, it will have to be more targeted. It will have to be, you know, focused on on particular areas where you're seeing these infections rise. It cannot really be a very easy blanket one. And secondly, what we know from country experience is that when you do contact tracing, when you do a lot of testing, widespread testing, you're able to address the problem much more quickly without having very stringent lockdowns. So that is an important, policy that I think seems to work well in many countries. The other thing, of course, is that if the virus cases are going up, sometimes regardless of whether you put a lockdown or not, people are staying home and not engaging in activity. And that's, that is something that can be dealt with if people have confidence in the medical system, in the government's communication, in the fact if there is sufficient information being provided. So providing confidence to people that this health crisis can be well addressed is another way of dealing with the health crisis while at the same time minimizing the impact on economic activity.
So I have to thank the audience because they're being extremely active. We only have 5 minutes left. So let me make sure to cover the two more areas where people are asking a lot of questions. One is employment and employment regulation. You talked about some of the features of regulation that may be tied to high informality in these countries and the intention of many of these countries to engage in reforms. What are your views on what is the focus of those reforms that is needed to make sure that, one, the recovery is fast, and then two, that the structural situation after this crisis is overcome, hopefully, will be the best possible?
So yes, I think this is related to what I had said earlier about ensuring that in the recovery that there is sufficient job creation and that people are able to move to sectors where there are actually jobs and there is growth. If you have the risk right now is a situation where you keep workers and firms attached, and then the sector itself is shrinking, and that's a major problem. So in terms of sectors where things that you can do to ensure a job-rich recovery, I think public works projects, for instance, especially the ones that support a green recovery, would be very helpful. Retraining, reskilling is going to be very helpful. Ensuring that people have access to good healthcare, education, all of those measures continue to be very important. And I think governments are going to have to pay very, very close attention as the situation develops, because this is a crisis where on a day-to-day basis, there's no new news on what's happening on the crisis front, and the policies will just have to adapt to that. So again, just to summarize, public infrastructure spending creates jobs, reskilling, retooling creates jobs, hiring subsidies targeted at communities and people that have lost a lot of jobs creates, it brings about higher employment. And from a much more medium-term, long-term perspective, just focusing on better healthcare, education, proper skilling, all of this makes a big difference.
Great. And lastly, I left for the end a set of questions related to the IMF strategy. So people are asking about the strategies and the role of IMF in different fronts. One is the IMF going to issue SDRs to help global liquidity, or is this going to fall mainly on the Fed? And I guess central banks is the question more in general. And secondly, what is the role the IMF is taking and is planning to take on all this coordination measures that you mentioned in your policy recommendations?
So the approach we've taken here is that this crisis has called for very rapid need in financing. So there are countries that obviously have to do health spending, and they're up against financing what they can do. And so we've been providing emergency financing to these countries, which come with no conditions. So typically IMF programs come with large amounts of conditionalities, but this is rapid financing to over 70 countries of about $25 billion. So that's the first thing. Second, we have low-income countries who have debt service obligations to the IMF. And what we've done is that we have forgiven the debt servicing for some period of time. And by providing them this debt service relief, they're able to use that money that would otherwise be used to pay the IMF to invest in their own country's needs. And then third, one of the big risks from this crisis is that there can be an international liquidity crisis. And people need access to funds. And so we have our flexible credit lines. We have a new short-term liquidity line that we've come up with. We're also supporting the G20 debt service initiative to make sure that low-income people get the debt service relief they need so that they can focus on their own country's needs. So these are the kinds of measures that we are engaged in at this point. There was a specific question about the SDR. As you know, to make a new SDR allocation, you need a membership to be on board with it. And at this point, we don't have that consensus to be able to make a new SDR allocation. What there is much of a broader consensus on is on better using the existing SDRs, which is kind of reallocating those to lower income countries that would need it. And so that's kind of what we're focusing on, which is on better use of existing SDRs as opposed to new SDR creations. Also, we have to remember that unlike the global financial crisis, when the IMF came into it, it had about $250 million lending capacity. Right now, the IMF has about $1 trillion in lending capacity. So we are in a much better shape to deal with this crisis.
Great. We covered many of the questions. Unfortunately, not all. People were extremely active, but time is limited. I want and have to thank you for these 1 hour of great and very deep content. We have learned a lot, certainly. Let me just highlight a few messages that I am at least left with in terms of the recommendations that you have made here. One, I think, important to highlight is this idea that the support that governments are providing going forward has to be very smartly targeted. The other idea that I think is extremely important of the things that you were saying is the crucial idea of keeping firms viable going forward so that they can serve as a basis for recovery. The investment in public works that are consistent with the green recovery. And then to me, the headline that I will keep in my mind is retraining and reskilling to address actually very many of the dimensions that we covered today. You talked about that in terms of how to make sure that the gains from globalization get to everyone, so that globalization is not only viable but indeed desirable going forward. But you have also talked about that in terms of how important this is for the recovery and for a healthy economy after we recover from this crisis. So thank you very much again, Geeta. It has been a pleasure to share the floor today with you, and it has been great for the department to be able to jointly organize this event. Hopefully we'll have you not too far into the future physically at the department. Well, thank you very much to everyone. Thank you to people in the audience for being here and for their great discussions and questions.
Thanks, Marcela. It was really a pleasure.